Morning, welcome. Very glad you're joining me. I'm going to give you a presentation on how I see markets, a little bit about South Africa, about Centaur, how I see markets and how I've positioned the funds. I think it's been quite a crazy week with riots and everything and a lot of mayhem. But hopefully I can convince you that we've still got the solutions to grow your funds. I'll try to do the presentation in half an hour. There's a lot to cover, and I'll take questions at the end. Just a quick business update. Our founding principles, which have been since inception, they really guide us, and particularly important to us, just to reiterate, it's to deliver investment excellence with outstanding service and the utmost integrity. We're currently operating 2 days from the office and 3 days from home. This is working very well. It's still in experimental stage, but so far very good, and it's increasing staff morale, and also particularly good for mothers who can see their children but still work. So I think it's a very good development. We're a retail-only asset manager. We don't have institutional funds. With 5.5 billion assets under management, focused in our two unit trust funds. Succession is very important to us. Kirsten Dale has been appointed as a key individual, while Jacques Hasbrook and Victor Voss are being groomed as portfolio managers. There have been some staff changes over the period, so we're very glad to welcome Lang Walker back. He left us last year to immigrate to the UK. He's still living in the UK, but he's working as a consultant analyst, and he brings a different dimension to the business. Working overseas, he's kind of amped into offshore opportunities, and we see this as a very positive development. We've recruited a new senior analyst, PJ Prinsloo. He's worked over 6 years, most recently at Nedbank Private Wealth, and he joins us on the 1st of August. And Kelly Sue Africa joined us. She moved from Johannesburg to join Centaur, and she's bolstering the operational capability, and we welcome her. She joined in mid-June. It's with some sadness that I bade Samantha Williams farewell. She's been with Centaur a long time. She's assisted with marketing and PR. But I did take on board Chris Aitchison over 3 years ago, and he takes over a role very capably. Just to give you some faces and the organizational structure of Centaur, Kirsten Dale heads operations. She runs a very tight ship and very, very competent. I think we've got a very strong team. They've been with Centaur journey a long time. We've got depth of experience, but a youthful team. So minimum of 6 years experience on any of our staff members. Just to reiterate our outperformance process, it's really 3 steps. We construct an efficient benchmark. This is the starting point, how we allocate funds. This is a long-term strategic allocation. So I've given the benchmark for the balanced fund. This is to target 4% real returns. This is the starting point. We then use quantitative indicators, judgment, and fundamental value to tweak our asset allocation, either overweight or underweight asset classes, to add some incremental alpha generation. And then we look for stock picking alpha to add further alpha to the portfolio. And by combining these 3 elements, we're looking for a robust system which also will deliver long-term performance and outperformance and meet our target real returns. This whole process has been built into a systemized stock picking engine called TopSeg. So we run this real time every day, and this allows us to make quick decisions under times of stress. And this has proven itself over many years. Most recently last year, during the crash in March and April, it was highlighting some exceptional opportunities. We capitalized on them, and some of them have gone up more than 2 times since we purchased them last year. Has our process been working? I'm glad to report very strong relative performance compared to our benchmarks. So over 3 years, the flexible funds delivered 11.5% odd returns, outperforming the benchmark by 5%, and very strong category ranking. Similarly, over 5 years, also strong performance, number 2 out of 40 in this category. And over 10 years, we're actually the first number 1 out of 32 in our category. So glad to report strong returns, robust returns in line with our targets, and also one of the strongest in the market in this category. Similarly, the Balanced Fund has outperformed its benchmark over all periods and very strong category rankings. Over 3 years, 9 out of 174, 5 years, 6 out of 143. So our funds are remaining near the top in our category, and that's what's very important to us, and also delivering strong, consistent returns to our client base. Where did those returns come from? So I've given you some flavor for attribution. I'm really looking at the major asset classes. So fixed income, the return from that component was 2.1%. The benchmark was 1.8%, but we were slightly underweight relative to benchmark. So our weight was 17%, 3% underweight benchmark. That was the weakest performing asset class. So our underweight exposure to that did add some asset allocation alpha. Local equities, we're at 55% versus a benchmark of 16%. We outperformed our benchmark by 3.4% for the 6 months. So we did add some stock picking alpha. And then offshore equities, we're quite overweight, we're 28%. Our maximum potential is 30% there, so we're very close to the maximum statutory limit, and we also outperformed there, so adding stock picking alpha there. I think we are going to be structurally overweight offshore. I think it adds diversity and an extra opportunity set, so that overweight component offshore, we don't see that changing for the foreseeable future. It's more of a structural long-term overweight. The net impact is that we've outperformed the benchmark for the 6 months by 3.2%. That's a very robust performance on an annual basis. On a post-fee basis, it would be close to 6.5%. So we're happy with the value added in the first 6 months. ESG, which is environmental, social, and governance, is becoming of increasing importance. We have explicitly put this into our process, and I'm not going to go into this much detail. I think most importantly, within the analyst research, they have to explicitly look at these issues and highlight any issues that transgressions that may raise red flags. The chief investment officer overlooks it, and then we have regular meetings to assess ESG risks in our portfolio. So this has been incorporated into our process, just making it more robust. And I won't go into details, but just bear in mind that this is within our process. Moving on to global asset market returns. Looking at the MSCI World Total Return Index over the last 5 years, that's the gray line. That has increased, has doubled over the last 5 years. So very strong real returns from global equities. The S&P 500 has outperformed that. That's up about 2.3 times. So even stronger returns from that. And then the NASDAQ's been an exceptional performer, up 3.5 times. This is one of the strongest returns from any asset classes globally over that period. And I'll unpack some of the reasons why. I think looking at returns, one has to bear in mind the discount rate, which we classify as the 10-year bond rate. You can see the EU 10-year bond, that's actually negative yield. So if you buy European government bonds, you're actually going to pay the governments to take your money. So that's what that negative yield means. The US, the yield is relatively low, below 2%. Recently, yesterday, it was 1.2%. So US bond yields are very low, and that's below the inflation rate. I think inflation is of increasing concern, particularly in the US. And if you look at the red graph, that's the historic core inflation in the US over the last 20 years. It's kind of been in a range between 1% and 3%, but just recently has spiked up to 4.5%. I think there is some concern in the markets that there is high inflation in the US. I think the official policy and the Fed policy is saying this is transient, and this is really due to a low base. So if you look at the 3-year moving average, that's the dotted red line, that's close to 2%. So that does bear out. I think there is some truth to this. A lot of these things seem to be transient, really a base effect, and inflation will dampen later. But having said that, there are certain elements of the supply chains where there is a lot of pressure. So, for example, some commodities are exceptionally buoyant, things like iron ore, steel, semiconductors, there's a shortage. So there are some shortages in the supply chain, which is leading to inflationary pressures. In the EU, that's the blue line, you can see inflation is still very low there at about 1%. Now, what has happened is if you look at the inflation and the very low bonds is resulting in negative inflation-linked bond yields. So this means you can expect to get negative returns if you invest in inflation-linked bonds of about -1% currently. And this is leading to very low discount rates in equities. If you want to make real returns, the only place you can invest is in equities. And this is what's really driven the very strong returns, as we saw in the first graph on things like NASDAQ, which is up 3.5 times over the last 5 years, is these very low real returns or negative real returns available. This kind of talks to somewhat of a perverse situation where the quantitative easing in the US, where the US is buying $120 billion of bonds a month, is forcing the real yields into negative territory, and this is inflating valuations globally. So particularly if we look at this is the Case-Shiller cyclically adjusted P ratio. This looks at cyclically adjusted earnings over a 10-year framework. The P on the S&P 500 is close to 40. This is one of the highest it's ever been. The only time it ever was higher was before the NASDAQ crash. So this is a concern, but I think the catalyst which would cause this to fall is higher interest rates. So this is something to monitor very closely and be cautious on this, because possibly if you sell once interest rates start moving up, possibly it will be too late. Also, this adjusted P ratio kind of talks to expected returns. When this is very high, future expected returns go down. So we are cautious on US markets. But having said that, I think it's very hard to call a top, and one has to take a strategy where you can perform even if this does derate. And we found some more value-orientated stocks. So we think high-quality companies on very low valuations, which we'll talk to later, that even if the market derates, these can perform. Locally, looking at the yield curve, that's the orange line. The orange line is the yields available on SA government bonds. So the nominal yields on the left, so the 10-year nominal yield is about 9%, but historic inflation has been 4.5%. So the real yield's close to 5% on the 10-year government bonds. On the 15-year bonds, they're even higher. They're close to 6%. And this is in stark contrast to what's available in Europe and the USA. We're seeing very high real yields available. And one really The reason why is I think they're very, very real risks. If we move on to the next slide, this is South Africa's debt to GDP, fiscal debt to GDP. You can see it bottomed in 2008, the dark blue line. It's been increasing consistently since then. And in 2020, February 2020, it was about 63%. And then the light blue line was the projection at the 2020 budget, slowly creeping up to 70%, maybe not a fiscal crisis at that stage. Then COVID hit. Then you had the green line, the 2020 supplementary budget review. Suddenly our debt had increased from 63% to around 80%. And then the projection was for it to slowly move up and then move down towards 2025. I think in the 2021 budget, that's the red line, you can see our fiscal situation has been revised up further. And the very high real bond rates are really talking to a fiscal trap in South Africa, where the growth and the ability of the government to fund itself hits an inflection point where the government can't fund itself. I think this is a very, very real risk. I think in the wake of continual disruption from COVID, so the economy is struggling to get off the ground because of COVID lockdowns, but also the riots are putting another damper, the riots from last week, another damper on economic growth prospects. It looks like the fiscal situation's actually getting slightly worse. So we're getting a bit more cautious on government bonds. The situation does look quite dire from this point of view. So some caution is warranted. I think on the rand confounds most people. We've found that following a contrarian approach to the rand and tracking the purchasing power parity has worked very well for us. So, for example, tactically, we bought rand futures at about close to 19 because the rand was overvalued, undervalued at that stage. And we reversed the position at about 14 rand 15. So by trading this contracyclically, we can add some asset allocation alpha. The fair value on the rand by our reckoning is 13.20 to the dollar, and currently at about 14.50. So about 10% odd off that. But we think this is in a fair value range. We think there are very real risks in South Africa, and so it isn't a fair value band. I think there should be a discount to fair value for the fiscal risks and political risks in South Africa. But we think the rand is going to remain relatively resilient. So if you're looking to move money offshore, I think if the rand gets very strong towards 13.50, where it was about 6 weeks ago, that is a good time to move money offshore. I think on the rand, there are asymmetric risks to the upside. If there is a fiscal crisis, inflation could move up and the rand could weaken. So even though we expect it to be stable, there is a scenario where the rand weakens considerably. The other positives on the rand, we're seeing record trade surpluses. Every month over 50 billion rand, these are very material trade surpluses. South Africa's got a very strong international investment position. At the end of September last year, it was about 2 trillion, so that's very, very material. This acts as a shock absorber to the rand. When it gets weak, the money starts flowing back, and we're seeing positive interest rate differentials, so another reason why the rand should be resilient. The economic outlook, I think there has been good policy progress over the last year. We've really come a long way. There's restraint in public sector wages, so they're looking to reduce, to grow public sector wages below inflation. There is some progress there. Announcements up to 100 megawatts renewable energy, electricity in the private sector. That's positive. I think there has been some progress on corruption with the imprisonment of Jacob Zuma, and also some progress with infrastructure spend. There has been stimulus in the form of lower interest rates. This is positive, also very strong terms of trade. So we're seeing record commodity prices, and that's assisting our trade surplus particularly, and tax receipts. Also, we're expecting a very strong global economy post-COVID due to the stimulus which has happened. I think there's better confidence among CEOs. They're looking to invest. There's more positive bias, and we're seeing recovering revenues off a very low base. This is also adding to confidence. I think a key negative is COVID. So we're seeing a stop-start environment. We're under level 4 lockdown. This does hurt the economy, and it looks like COVID's going to be with us until at least 2022, where hopefully it will start abating. I think a key negative, and this is of increasing focus, is really the lack of state capacity. We can see it with the riots, the inability of the police and the army to respond quickly and have the resources to stop the looting. And also there's a lot of red tape as a key bottleneck for growth. And the government, this is really a priority that for the government to start confronting these very real issues to improve our potential growth rate. I think the KwaZulu-Natal riots, this will have some direct negative economic impact, but I think on the positive side, a lot of retailers said the impact's not going to be as much as expected. The distribution centers are operational. They have closed some stores, but it's not as material as expected. So hopefully the impact won't be as material as expected. However, it does raise the risk premium. I think it also creates uncertainty with investment. So for example, Toyota's possibly a thinly veiled threat that they may close their plant in Durban. So it does really raise the risk premium. I think it will reduce investment at the margin. But I mean, on the positive, I think the government really has to kind of look at itself and say, we need greater accountability from all elements, that the police have to do their job. And there's lots of elements in the supply chain of the government that really needs to be a lot more responsive, and hopefully we'll see some progress from government. I think the economic growth outlook is stunted by structural impediments, and we're only looking for growth of between 1% and 2%. So at the end of March, the economy was still below the level 5 years before. So it was still lower than March 2016. We've painted the two scenarios of 1% growth and 2% growth. If we grow at 1%, we're still going to be below our peak at the end of 2024. If we can grow at 2%, the economy will break past the peak, and then the fiscal situation will not look as dire. So this is very, very important for South Africa, really, to allay some of the social concerns out there and really get the fiscal deficit down. Growth is very, very important, and the government, it needs to be a greater priority for the government to get South Africa growing again. I think the PEs on our markets, if you look at the blue line, that's the industrial 25, that's about 18 times. That's really skewed up by Naspers, which is on a very high PE, but it doesn't really look too elevated at this stage. The financial index, that's on a P of 10, relatively depressed, and despite a recovery in markets, has not moved up radically, whilst resources, the P is quite low, and we're seeing very good profitability there, and the market's saying the profits aren't sustainable, and that's why it's a very low P. We think actually resources are an opportunity at this stage. We look at the interest rate cycle as a guide for asset allocation. We found this is the best long-term strategic guide. There's two different phases, a tight phase, which is explained on the top, and a loose phase. You can see the annualized return in the tight phase has been -1%. That's the red phase on the graphs on the right. The loose phase are the green on the graph, and the return's been 26%. We are in a loose phase, so we favor increased equity content. And you can see within the flexible fund, we've increased the equity content. So strategically, we were underweight equities from 2015 to 2020. In the latter half of last year, we did materially increase equity content. We're currently around 84% equity content overweight. We think this is the right strategy, really guided by a number of indicators, but really primarily lower interest rates. I think the investment outlook, I think SA bonds look attractive relative to cash, but there are very real risks. We've come a little bit more cautious. We think the economic growth outlook's not as good as we initially expected, and we are neutral on SA bonds. We think it's an opportune time to invest in South African equities. Really, we see some upturn in the economy, maybe not very strong, but also lower interest rates, which favor investments in equities, and we're relatively fully weighted. We're looking to invest in cash generative shares, higher quality shares that can grow rather than lower quality, maybe more cyclical shares. I think we see good prospects for a resource super cycle, which we categorize as a period of elevated commodity prices above the long-term average. The reason why is very limited new supply and strong demand. So we've been upweighting exposure to commodities, select commodities, things like Anglos, for example. We're quite positive on iron ore. That's a key driver. We're also positive on copper. Another share we've got a large weighting is African Rainbow Minerals, which we think is trading at a big discount to some of the parts. I think we're cautious on global valuations on a macro level, but we do see some high return opportunities in selected value stocks. For example, Dell, the business model is exceptionally cash generative, an exceptional entrepreneur, a global brand, strong market position, and that's a special situation, and we see it trading on a 16% free cash flow yield. We think that's exceptional. Some other opportunities, Hewlett-Packard, Stellantis, which is one of the largest global auto manufacturers with a good EV strategy, and Entei. And I'll discuss some of these on the next slides. We're also improving the quality of the portfolio via selected switches. So we sold Sappi. We bought that last year. We actually made reasonable returns, but we don't think it's a high quality stock and not well positioned for the future. And we've switched that into Anglos. Another switch we did, which has done exceptionally well, is we moved all of our exposure in healthcare into life healthcare, and that's added a lot of incremental value. Just the positioning, I'll go through this quickly. And the balance fund, currently we're 34% in fixed income, 66% in equities, slightly overweight. Bonds, we're 25%, which is in line with our benchmark. And we see ourselves as being strategically overweight for the foreseeable future. Similar story on the flexible fund. We overweight equities, 84%. World equities, 27% versus a benchmark of 20%. So overweight there. JSE equities close to benchmark of 60%, but combined overweight. In the fixed income, in the flexible fund, we've got government bonds, 8%, more on the shorter end of the yield curve. Just to give you a flavor of where we invested. So as I mentioned, offshore equities 27%, SA equities 57%, and really we're quite well diversified. International are locally listed companies with primarily offshore operations, things like Naspers and British American Tobacco. Resources 13%, defensive growers 19%, and the more cyclical South African stocks like retailers and banks 18%. The rand hedge component of the portfolio on a see-through basis. So we look at the source of earnings. So something like Aspen, we say 75% earnings are actually from out of South Africa, and we weight that by our holding to get the rand hedge component. Currently, that's 56% of the total portfolio. To some of our larger equity holdings, Entain we've had for about 2 years now. It's performed exceptionally well. It's more than tripled from our original entry price. We essentially leaving that position. That's why it's grown to such a large holding. We think this position is exceptionally well placed for continued growth. So it's the second largest sports betting company in the world, exceptional technology. And what is happening is the US market is just opening on a state-by-state basis. They have an operation there. They're the second largest in the US, which is going to be an enormous opportunity, and we see ongoing growth. So we are just leaving Entain. We think it can continue to perform. Exor, this is trading at a large discount to some of the parts, over 40%. It's under the leadership of John Elkann, who's an unbelievable value creator. For the first 6 months, it actually has been slightly disappointing, whereas Entain's been exceptionally good. Aspen we bought last year has performed very, very well. It did restructure last year into higher growth markets. It reduced its debt materially, and it's also well positioned for the African vaccine opportunity. We just see that the US government's probably going to invest $200 million into its facilities to increase vaccine availability in South Africa. African Rainbow Minerals, we did top this up. It's a 4% holding of the fund. It's empowered, which is very important in South Africa. It's got a very good diversified mix of minerals, so mainly iron ore, manganese, and platinum group metals. We see it trading currently at about a 35% discount to some of the parts. Stellantis, we've been in for a number of years. It actually has been a very, very strong performer. And really what we like is the strategy of management. They're very shareholder orientated, and they're very well positioned for a transition to electric vehicles. They're jointly with Volkswagen, the largest European vehicle manufacturer, owning Peugeot and Fiat. And we see that as Europe as the first region to adopt electric vehicles, and they've got a very strong strategy which should lead to strong shareholder returns. Life Healthcare we actually bought opportunistically last year. It's up almost 50% since we bought it. We think it's well placed to benefit from pent-up hospital demand. As COVID phases down, there's going to be a lot of catch-up demand. We also think COVID may be with us in perpetuity, and that's going to probably lead to a possibly 3% increase in caseloads, so that will benefit them. And they've also got a drug called Neuraceq, which is used in Alzheimer's diagnosis, and this could be quite material. We haven't really valued it, but we think it is upside optionality. I think concluding, Centaur's operating smoothly. We have a very strong team. I think our process, which we've been working on and it's in constant refinement, gives us an edge to outperform benchmarks, and I'm pleased to report very strong performance. The portfolio is focused. We think we've taken a lot of care in selecting great opportunities, and we expect it to deliver strong real returns. The team is youthful, but with loads of experience and a proven ability to outperform. Centaur is on top of its game and really focused on delivering superior performance. Thank you. I'll address questions now.
Thank you for your time and insight, Roger. Looks like you've covered a lot of these questions during the presentation, but just to satisfy the people asking the questions, we'll just run through a few of them. Are you still bullish? Are you still bullish on the rand?
I think I covered it quite a lot in the presentation. I think the rand's going to be resilient, really because of the positive factors I highlighted. but I mean, I think having said that, so I expect maybe the lower end to be towards 1350, towards 15 within that range. So it's going to remain resilient. But I think one must bear in mind there are asymmetric risks to the downside. So we can't see the rand going to 9, but there is a lot more potential. It could go to 25, for example. So one should have a large rand hedge element to hedge out these asymmetric risks. Thank you.
Can Entain continue the good run?
We believe Entain can continue to perform. I mean, it's been exceptional, but I think we have been fortunate. The US operation has taken off better than our original expectations, and we see that opportunity as really enormous, possibly a $40 to $60 billion opportunity where they can get close to 20% market share in that. So that is very, very material for them. And their technology is exceptional. It's a very technology-intensive business and not an easy technology to fine-tune. So very well positioned there. And then they can also expand geographically. So they moved into Scandinavia this year, places like Estonia, Latvia. They can still move into Eastern Europe and Latin America. So there's a lot of ways for them still to grow. They're still performing exceptionally well. So their most recent trading update still surprising on the upside. And sometimes you just need to let your winners run. And really, that's what I'm doing with Entain.
Do you believe commodities are in a super cycle for demand? And how long will it last?
One has to always be cautious about these things. And I think one has to be very selective on various commodities. So, for example, iron ore, which is very important for South Africa, Anglo's, Kumba, Exxaro, BHP Billiton, iron ore is their biggest profit source. We are actually very positive on iron ore because there's very little incremental supply coming on stream, and there's very strong demand. So we think these high prices of $200, where Anglo's or BHP Billiton are making margins over 60% are sustainable for a while yet. So we see elevated prices till the end of 2022 at least, and maybe further. The outlook for copper is very good. If you look at the whole renewable economy, we see massive increase in demand, maybe more late in the 20s for copper. So the copper outlook's good. But one has to also be cautious. So platinum group metals, if you look at the projections for electric vehicle sales in Europe, it's very, very concerning for palladium and rhodium, because electric vehicles are going to have zero loading of palladium, for example, and we could see demand radically fall off in the mid-decade. And we've actually been selling Sibanye quite aggressively. It's been a very strong performer, but we're very, very concerned about palladium. And that's also a concern for South Africa, because palladium and rhodium are some of our biggest exports. So that's another concern. So we are selective, but I think we are positive on commodities, at least for the next 18 months.
How do you see the financial, economic, and investment climate in South Africa over the next 2 to 3 years?
I think it's going to be more of the same. I think Ramaphosa has started making some changes, but a lot more needs to be done, more on the micro level and the execution level. So some big picture stuff needs to be done. The meddling of the state in the economy needs to reduce, and really the delivery of the economy of the state has to increase. For example, if you're not creating an environment, a safe environment to invest in, where the rule of law applies, there can't be investment. So I think we're facing a difficult situation, and hopefully we see some high-level changes made post these riots. But we think it's going to be relatively difficult.
Can you elaborate a little bit on understanding valuations versus probability of returns?
Well, I think this is kind of a very conceptual question. But I think, one can value a business, but unless there's management or some event unlocking that value may remain dormant for a period of time. So I think what we look at is we look at a valuation, but we're also very cognizant that one has to look at how, through the passage of time, this value dynamically evolves. So if there's no value unlock strategy, this discount to fair value could remain in perpetuity. So hopefully that answers that question.
What is your?
I don't know.
There's a couple more questions. What is your take on hydrogen drive globally?
Hydrogen, I've done some research into this. Apparently, there's a lot of slippage between, let's say you make hydrogen through solar power, and then you reconvert it to electricity through fuel cells. It's quite wasteful. You only get about 45 to 50% of the power comes back. So it's not that efficient compared to batteries. But I think there is a place for hydrogen, maybe more on buses and trucks. So I think there is a place in a green economy for hydrogen. For example, Peugeot is introducing a line of vans which will be hydrogen powered, and that's already later this year. So there is some hydrogen, but there are challenges really on the storage, and we see it more as a niche product for buses and trucks and vans.
One final question: where on the South African bond yield curve are you buying?
So we've been buying the 2032 because it kind of spikes up, and what happens is, so that's about an 11-year bond, and you get, as it approaches the 10-year, you get a re-rating, but those have performed reasonably well this year. But I'm coming increasingly concerned about the fiscal situation, in light of the COVID events and also the riots, and also the need for the government continually to create these grants. The fiscal situation is getting more and more tenuous. So we are getting more concerned, and possibly look at other areas to invest in fixed interest.
There's just another question come through. Your view on Naspers process Tencent?
So I think Naspers, there's a situation where you're swapping your Naspers to process. There's potentially 7% upside on that switch. So Naspers in the short term can move up. It's a bit more complicated than that because it depends how much you allocated. Also, there's a very strong buyback in process, which should underpin it, and also a movement into indexes. So that could underpin the short term. In the short term, Naspers in process could be underpinned. I think longer term, we really do have some question marks about the dynamic value creation strategy. So, for example, they're moving into food delivery. We are not certain on the business model whether it's really viable. So we really don't like that strategy of selling Tencent, moving it into food delivery. They haven't had any great success on the investments in over 10 years, any massive windfalls. So we don't like the dynamic value creation strategy. We'd actually like the business to simplify up, maybe be much smaller, much more focused, and really return money to shareholders. So longer term, we actually, we like Tencent, but we don't like Naspers' value creation strategy. So in the short term, there could be strength. Longer term, unless there's changes, we're not super excited on it. We would prefer to invest directly through Tencent. I hope that answers that question.
Thank you. We'll take one last question. What is your view on the hospital groups? Do you still see sustainable returns in life healthcare?
So life healthcare, I think there is a bit murky because there's been a lot of disruption because of COVID. So caseload has dropped, but we think it's well placed. So it's really three elements. It's the South African hospitals. We see some short-term, we see a recovery in volumes, things like hip replacements, which have been deferred. So in the short term can do very well. Longer term, structurally still quite good. The UK operation, which is the radiology, that's very well placed. We see that doing very well. And then it's the Neuraceq drug. This is for imaging for Alzheimer's in the brain. That could be that could add about 30 cents to earnings. So I think summing up, we are still positive on it. I think it's a more defensive stock, more in a secular growing industry, and we think it can still do relatively well.
Thank you, Roger. That concludes this morning's presentation.
Thank you very much. Thank you very much for your time, and I'll do a follow-on presentation in 6 months, and hopefully you'll be there. Thank you very much.